Thank you so much for checking in the channel. My name is Agabus. This is the Financial Education Channel. This article is brought to us by The Motley Fool. The article says this stock market indicator has been right 83% of the time since 1983. And right now, it's sending a bullish signal. Interesting. This will be a little bit different from some of the articles we've read here the last couple of days. Let's see what the article has to say. Rising prices has hit the U.S. economy hard on the heels of the pandemic, and many believe some blame lies with the Federal Reserve. Had policymakers moved more swiftly, they may have been able to quash inflation before it reached a 4-decade high. Side note, I would be one of those people. Instead, the Fed delayed actions for months, then attempted to course correct by pivoting into the fastest series of rate hikes since the 1980s. As you can remember, the Federal Reserve was asked over and over again, is this inflation that we're seeing transitory? Will it just go away on its own, or was there some other issue that was happening? The Federal Reserve's answer was it was transitory and it'll go away on its own. As we can look back in history, or as they say, history is 20/20 vision, that was not correct. So that chain of events worried Wall Street with these rate hikes. Many investors feared the Fed would over-tighten, which still may be a concern, and choke the economy into a recession. Those concerns of a recession are slowly starting to fade away. However, there are still stragglers out there who think that we may still see a recession. This interest rate hike did cause the S&P 500, one of the top U.S. indexes, to nosedive into bear market territory last year. But the index has rebounded sharply in recent months, propelled upward by some signs of economic resilience. I would argue in another article that we're going to read, it's not so much economic resilience or better than expected earnings as this article would argue here, but it is the interest or the idea of AI. Again, stay tuned for another article, which we'll discuss that coming up down the road. Another indicator to watch, again, according to the Motley Fool, would be, according to the article, the stock market could soar when the Federal Reserve stops raising interest rates. Now, there are two sides of this coin. There are some in this group, which will continue to read the article, that says when the Fed stops raising rates and starts to lower those rates, then the market will start to take off again. We'll get back into some quantitative easing or some cheap money. There are some on the other side of the spectrum who think that once the Federal Reserve stops raising rates and lowers them, that's when the real market may crash. We will see which side of the coin is correct in the months and years to come. The article continues that the Federal Reserve has guided the economy through 6 rate hike cycles, excluding the current one since the 83, and those events have historically affected the stock market in similar ways. Specifically, the S&P 500 increased during a 12-month period following 5 of the last 6 rate hikes, again, having a positive return 83% of the time. Better yet, the S&P 500 gained an average of 16.7% during the year following each of those 6 cycles and gained on average 46.2% during the subsequent 3 years. Again, as long as you hang on. That information is particularly timely because core inflation has fallen to a 21-month low in July, so many investors believe the current cycle has run its course. But even if the Fed tightens credit conditions a little bit further, according to the article, the futures market is signaling 2 more rate hikes at most. They would likely be affected when the Federal Open Market Committee meets in November and December. The bottom line of the idea is that history says the S&P 500 could soar following the final rate hike in the current cycle, and that event has either already happened or is fast approaching. Again, time will tell where the market will go based upon these rate hikes, based upon the rate pivoting and the pausing and potential decrease of those rates. There is still another reason that some will believe the S&P 500 is headed higher. What they're looking at here is 2 metrics that account for 85% of gross domestic product is the consumer spending and business investments. Those headwinds cause economic growth to decelerate in the fourth quarter, but that trend seems to be unwinding. Sequential GDP growth accelerated to an annualized 2.4% in the second quarter, crushing consensus estimates by 60 basis points, which is a good thing to hear. And the third quarter GDP is currently forecasted to increase at an annualized 5.9%, due in large part to strength in consumer spending and business investments, according to the Federal Reserve Bank of Atlanta. So, economic momentum appears to be snowballing, meaning the odds of a significant downturn are diminishing. As I had read in an article before, both JP Morgan and Bank of America recently have recanted their predictions of a recession. We will see what that looks like in the next couple of months, couple of years ahead. Thank you so much again for tuning in. We will see you tomorrow.